In 2026, Americans are feeling the impact of persistently high interest rates on almost every aspect of daily life. While central banks often raise rates to control inflation, the ripple effect can change household finances, business operations, and consumer behavior. Understanding these dynamics is essential for managing money efficiently and planning for the months ahead. Higher interest rates make borrowing more expensive. Mortgages, personal loans, and credit card balances carry higher monthly payments, which can reduce disposable income for families. Home buyers often face tougher choices as monthly mortgage obligations rise sharply. Many potential buyers postpone purchasing property, which slows the real estate market. Landlords may raise rents to cover higher mortgage costs, further straining household budgets. Auto loans are also affected. Financing new vehicles becomes pricier, encouraging many consumers to consider used cars, delay purchases, or opt for lower-priced models. Dealerships notice decreased foot traffic, and automotive manufacturers may slow production in response to weaker demand. Similarly, large appliances and electronics purchases often get delayed because high-interest financing is less attractive, and cash purchases may dominate. Credit card holders experience higher rates on revolving balances, meaning even minimum payments increase. This can reduce spending on non-essential items, including entertainment, dining, and travel. Retailers notice a shift as shoppers prioritize necessities over discretionary goods. Restaurants, coffee shops, and online retailers may see slower sales growth as consumers tighten budgets to avoid accruing interest. High interest rates also influence savings behavior. Higher yields on savings accounts, certificates of deposit, and treasury bonds encourage Americans to save rather than spend. While this can strengthen personal finances over time, it reduces short-term consumption. For example, families may hold off on vacations, luxury items, or home renovations, preferring to grow emergency funds. Small businesses face similar pressures. Borrowing for expansion, payroll, and inventory becomes more expensive, which can lead to reduced hiring, delayed projects, and careful cost management. Some businesses pass higher borrowing costs onto consumers through increased prices, further slowing everyday spending. Service sectors such as gyms, salons, and entertainment venues often notice fewer new subscriptions and memberships during periods of elevated rates. Even broader economic trends reflect these changes. When consumers spend less, companies earn less revenue, potentially affecting stock prices and investment decisions. Lower corporate profits can limit wage growth, leaving households with less disposable income. Financial advisors often recommend adjusting monthly budgets, paying down high-interest debt, and reconsidering large expenditures during these periods. Interest rates also affect student loans. For recent graduates, higher rates can significantly increase monthly repayment amounts. As a result, young professionals may delay major life decisions, such as moving into new apartments, buying cars, or starting families. The compounding effect of high rates creates a cautious financial environment across multiple generations. Additionally, inflation interacts with interest rates. Even when prices stabilize, high rates can suppress borrowing and spending, limiting economic activity. Consumers may prioritize essentials like groceries, utilities, and transportation over luxury or non-essential items. This reshapes retail patterns, leading to increased demand for discount stores, bulk purchases, and promotions. Investments in the stock market or mutual funds may also shift as higher interest rates make bonds and fixed income products more attractive. Investors often reallocate portfolios from equities to safer instruments, reducing capital inflows into growth-focused companies. Lower stock performance can affect retirement accounts, employee stock options, and consumer confidence, which in turn influences everyday spending decisions. Travel and tourism are noticeably affected. Airlines, hotels, and rental services may see lower bookings as families choose staycations or local experiences over costly vacations. Credit card reward travel plans become less appealing when balances are high, further reducing discretionary spending. Consumers focus on essentials first and postpone lifestyle upgrades until rates stabilize. Even small lifestyle decisions are influenced. Dining out, subscribing to streaming platforms, buying fashionable apparel, or upgrading electronics may all take a back seat when loan payments and interest costs rise. Households become increasingly cautious, tracking monthly expenditures carefully to avoid unnecessary debt accumulation. The housing market, auto industry, retail, and service sectors collectively respond to these behavioral shifts. Central banks monitor these trends closely, as reduced consumer spending can slow economic growth. Policy decisions often balance controlling inflation with avoiding excessive slowdown in consumption. In conclusion, high interest rates in the United States significantly impact everyday spending by increasing borrowing costs, encouraging savings, and promoting cautious consumer behavior. From mortgages to credit cards, from car loans to discretionary purchases, households and businesses alike adjust to maintain financial stability. Understanding these effects helps Americans make informed decisions, prioritize essential spending, and plan strategically for the future. Whether budgeting more carefully, delaying large purchases, or reallocating investments, consumers adapt to the financial environment created by elevated rates, demonstrating resilience and long-term planning in uncertain economic conditions.